Hey everyone, this is Eva from Acctivate. Welcome to our webinar on Activate transactions in QuickBooks. Today we're going to mix it up a little bit. We have a guest speaker here, Keith Felicia from Mendelsohn Consulting. He has years of experience working with both Activate and QuickBooks. In fact, he does QuickBooks solution providing as well. And we're going to talk a little bit about the Activate transactions in QuickBooks, what goes into QuickBooks and what doesn't. So Keith, I'll let you take it away.
Awesome. Thank you very much, Eva. Great to see everyone or see everyone's name listed on the attendees today. Apparently this is a hot topic, and it's something that when we go through an Activate implementation, we like to let people know what's happening inside of QuickBooks. Because if you don't know, your accountant's going to ask questions, you're going to be wondering what's going on, and it's an extremely important aspect of it. The way I like to describe it is Activate becomes your operational software. It's your subledger. It is where all the transactions happen, and QuickBooks becomes just strictly financial software. Now, everyone's probably seen the slides. This slide in the sales presentation, but Activate really manages your everything to do with inventory. I like to say it's like Vegas. What starts in Activate stays in Activate, and then we send information over to QuickBooks, and everyone, both of them have their own role that they like to perform. The actual transactions that go over are invoices, payments, bills, and journals. So if you're looking for a cash flow projection, you want to look at that in Activate, because Activate has your open purchase orders. QuickBooks doesn't know they exist until they become a bill. It has your open sales orders. QuickBooks doesn't know that those exist until they become an invoice. So it's a very, very important distinction about what happens where. Some of the bigger mistakes that I see people make is that they will adjust an entry inside of QuickBooks that originated in Activate. That tends to throw the two off balance. So we really want to focus on what transaction is appropriately done where. And the rule of thumb I like to go with is if it started in Activate, finish it in Activate, adjust it or change it in Activate. Now, everyone, of course, is familiar with QuickBooks. So in QuickBooks, when you set up QuickBooks, you have one set of an accounts to choose, and this is on every item. So you create an inventory part, you pick what's the cost of goods sold for this inventory item, what's the income account for this item, and what's the asset account for this item. Those are the three things that you have to pick for every item inside of QuickBooks. And it's interesting, when we go into a go live with Activate in the model company, Activate will actually pull in every combination of these that you can think of. And I have seen where in QuickBooks, somebody has set the COGS account as the income account as the COGS account, the wrong asset account, and and with Activate, when we pull it in, it's super interesting to see how many different combinations that people can possibly come up with. So this is the only way. There's one and done. That's it with QuickBooks. But when you get into Activate, many people don't know there's actually 5 different ways that we can assign sales and COGS accounts. So in Activate, we assign the inventory asset to each warehouse. So it might be a situation where we set up a warehouse, each warehouse with their own asset account. We can have virtual asset accounts in QuickBooks on the balance sheet. And we can, so there's different ways. So that drives the asset account. So that takes away from the, what asset account is this individual item going for? So when you turn on any of these, and the most common is product class, and the reason it's most common is that's what comes over from QuickBooks. That's the original setting. But it's a whole class, so I can have a bunch of items set up as an accessory, and all of those items are going to point to the same GL accounts for sales income and cost of goods sold. Now, when you see a product class in QuickBooks, it's very different than a product class in Acctivate. In Acctivate, it's simply, this is a group of items. Product classes in QuickBooks or QuickBooks classes are quite different, and that's a longer conversation to have, but it's about looking at a P&L more vertical or horizontally rather than vertically. So you always can pick different COGS accounts and different sales accounts for this. Then we move to branch tracking. So if we turn on branch tracking, and if anyone's ever been in configuration management, you'll see that these will open up. As I switch between the sales accounts, or between the type of sales and COGS, it will actually open up each of these. So when I use branches, I will sometimes do this virtually. If I need to change a P&L account on an order-by-order basis. So when I create an order and Acctivate, I can have different branches set up that point to different P&L accounts, so that I create the sales order, and now I can pick a specific branch that's going to change what accounts receivable account it hits, what sales GL account it hits, and what cost of goods sold account. And that's sometimes where I'll use branch tracking. Sales category, it's similar to product class. I don't think I've ever using sales category as my P&L accounts, but you can get more granular so that I can say, you know, here's my accessories, and below that I've got different types of accessories for my business, and I want to get much more granular. So sales category is another one. Salesperson. We can actually have different GL accounts assigned to each salesperson. So if I want to see how effective one salesperson is over another, who gets me the most margin, I might want to track by individual salespeople. And then this can also be changed on an order-by-order basis if if the user has the rights. Customer type. It's another common one that I use. If I have a client that is got you know, wholesale, retail, distribution, and we always want to see each of those separately, I will often set them up so that when you pick the customer, that customer type is allocated to that order. You can't change it on the order. It's always going to go into that account. And this what we want to avoid in some cases is folks having to change things. You know, we want to make this more rigid so we can see results. Because if people are changing things in how you're tracking sales and COGS all the time, it's really hard to run comparatives and see what's going on. The next option is we're going to talk a little bit about QuickBooks class tracking. If you see this, you know, you can pick your sales and COGS accounts, and we went through them. You pick, if you want to do QuickBooks class tracking, what it does is shows you horizontally across, I didn't mean to do that, horizontally across the top, that I can see the different lines of business, same income and expense accounts, but it just separates them for me, and then I can add percentages if I want to see as my wholesale business as profitable. You know, one of the ones that I like to use for classes is if we have clients that deal with Amazon. Amazon, for any of you out there that deal with them, it can be very, very interesting, because with all of the fees, sometimes you don't know if you're winning or losing. So we like to separate, you know, kind of Amazon on the P&L, so I can take a look and go, yeah, you're making money, or you need to raise your prices, or you're not making money with Amazon. A lot of folks aren't making as much as they think because they're not tracking it individually. It's all kind of moved into the into one bucket. Okay, this is the where I talked about the warehouse setups. When you get into setting up Acctivate, and we're going to talk about these accounts, your warehouse setups, each warehouse carries its own valuation. That's different than QuickBooks. In QuickBooks, it's one value. If you have Enterprise Platinum with multiple sites turned on, it still carries one average weighted cost across all of your warehouses. With Acctivate, it carries its own cost per warehouse, because if I have to ship something from California to Florida and I'm doing landed cost, the cost to actually have that item ready for sale is much higher in Florida because I've had to ship it across the country. So we can actually have separate GL accounts, accrued purchase receipts we're going to talk about. You can have different inventory adjustments and gain loss. Different transactions will hit these. And then accrued landed costs we'll talk about. And then we move to the non-inventory accounts. So this is what I call squeezing the balloon, an offset account. So if I want to take part of my payroll expense and move it from my payroll expense on my P&L into the value of an item. So I'm a manufacturer. It takes an hour to manufacture something, and I've got a cost for labor at $30 an hour. So I want to incur $30 from my P&L, from my payroll expense, up into the cost of that item because it's part of my true cost. This would allow me to do that. So normally what I would have is my labor cost offset would be a payroll expenses offset, like a sub account, so I can make sure I'm capturing enough of the payroll expense into that line. And you can do non-inventoried, where we move a non-inventoried standard cost from cost of goods sold up into the item that we're manufacturing or selling. Other charges we can use for things like overhead. If I want to take a portion of my overhead in manufacturing and allocate it to the cost of that inventory, move it to the balance sheet until it's sold. This is where I would set up all of those accounts. So the setup is critical, of course, because the more setup we do in prep, the more accurate our financials are going to be. Okay. Now, I mentioned earlier that in Acctivate, it's your operational software. This is where everything is going to exist. So if I wanted to as a cash flow forecast, I wouldn't want to look in QuickBooks for that because I don't know how much I'm committed to on purchasing. I don't know how much I'm committed to on, or I'm expecting to come in dollars, and how much service revenue. These are all the non-posting transactions. So in QuickBooks, you used to have purchase orders and sales orders tied to items. Those you could look at and get a prediction. But since they no longer exist inside of QuickBooks, we need to go to Acctivate and say, how many open purchase orders do I have and what's the value? Because at some point, I'm going to owe that money. Same thing with sales. How many orders are out there waiting to be fulfilled, because that's going to be money in at some point. And then business activities, which are generally RMAs. We can also, with business activities, track number of prospects, number of quotes that are out there, how many service orders we have. So that's all part of this. And I can't reinforce enough that for the state and health of the business, you really need to look at Acctivate. That's what's going to tell you where you're at much more effectively than QuickBooks. Transactions that post, this is, once a transaction posts, this is when QuickBooks actually sees the transaction. So we have purchasing, your inventory receipts, and I will go through the GL accounts that impact each of these. Your vendor bills or purchase invoices, payments that you've made. They go from Acctivate into QuickBooks. You have your sales. So once you turn a sales order into an invoice, it goes to QuickBooks. If you're receiving payments inside of Acctivate, those will go over to QuickBooks, and your cost of goods sold will go over to QuickBooks from the sales. Inventory, adjustments, issues, we're going to talk about issues, inventory counts, landed costs, and assemblies. So now we're going to get into some of the different cost methodologies that you can do in Acctivate. People in QuickBooks, you're using one of two. You're either using average weighted cost or FIFO. FIFO is if you have QuickBooks Enterprise Solutions with advanced inventory turned on, with FIFO turned on inside of that. In Acctivate, we have average, which is a calculation. Everyone should know what average cost is. I have 10 at $1. I buy another 10 at $2. My average cost is now $1.50. Then I sell some, and it'll keep moving. It continuously calculates until I hit 0, and then it kind of resets. Standard we use for non-inventory parts. So when I mentioned labor, trying to allocate labor in manufacturing, if we set that as a standard cost, and then I can say every time I use one unit of labor, I'm going to use $30 or $50 or whatever number I put in there. That's that offset cost idea. FIFO. It's another common one. LIFO is very, very not common at all. As a matter of fact, it's my understanding that if you are on any other methodology than LIFO, you actually have to apply to the IRS if you want to switch to or from LIFO, because it can have a significant impact to your financials. And LIFO being last in, the last thing I bought, that's the first cost that's going to go out, and FIFO the opposite. First item I bought in my inventory, that's going to go out. Actual cost, huge fan of this. If you're tracking lot numbers or serial numbers in Acctivate, I highly recommend, encourage, and pretty emphatic about it, that you go to actual cost. So if serial or lot number 1, 2, 3 cost me $10, and serial or lot number 4, 5, 6 cost me $20, when I pick 1, 2, 3, it'll use a cost of $10. 4, 5, 6, it will use a cost of $20. It keeps things a lot cleaner, and for reporting and just function of Acctivate, it works much better if you're doing serial or lot number, that you use actual costing against it. There's so much more we can do about it. And I've seen setups where they should have been set up as actual cost, and they were average, especially in this day and age, as we're seeing with some of the tariffs that are coming in on some of the items that are coming. I want to know that I'm profitable and moving inventory through at that actual cost. Okay, so now we are going to talk about one of my favorite accounts, which is accrued purchase receipts. So when I do an inventory receipt, the actual transaction is debit to inventory, increase the value of my inventory, credit to accrued purchase receipts. So what accrued purchase receipts is it's a other current liability. It sits on my balance sheet. It just means that I've received goods that I don't have the vendor bill for yet. So I'm going to owe somebody money. Well, that's why it's an other current liability, but I just don't know who yet. I will beg everyone that with accountants here, sometimes accountants don't understand inventory suspense accounts, and that's what this is. Again, real simply, it is I got this stuff. I'm going to owe somebody the money. I just don't know who yet. So I've seen this get zeroed out to cost of goods sold at the end of the year. It's a real liability. It should not be zeroed out at the end of the year, not even a little bit. It should be reconciled monthly to see what it should be, but it should never ever be zeroed out. So that's super important. Once you get the vendor bill, then the vendor bill is actually a debit to accrued purchase receipts, zeroes out that original receipt, and a credit to accounts payable. So this is an important transaction because it zeroes it out, but it also is a transaction that makes it difficult to reconcile this account, the accrued purchase receipts account, because the way the QuickBooks software developers kit, the connection that Acctivate has to use works, is it sends over the initial transaction as a journal entry for one amount, and then it sends each bill over as line items. So if I've got a $350 receipt but the vendor sends me a bill and it's only for $100, I can't reconcile just like I would a bank account. So I've got to just kind of monitor it. And there's a couple of reports that I use that tell me what should the value of the accrued purchase receipts accounts be. Now, inventory receipts, going back there for a second, this is a place where people can really, I'm going to say, mess up their financials. So understanding the concept, inventory, I do a receipt, debit inventory, credit accrued purchase receipts. People like to use inventory receipts to adjust inventory. They like to use it to change the value of inventory items because something got messed up. The problem with doing that is any sort of adjustment belongs on the profit and loss or the income statement as an inventory adjustment. If you're using this transaction to try and adjust your inventory, it's actually sitting on your balance sheet in accrued purchase receipts forever and ever, because there will never be an offsetting bill that will zero out that receipt. So it's sitting in the wrong place, and I've seen a number of them where I have to go in and clean them up and run a report of what it should be, and they can get pretty significant. The dollars involved can get big over time if you're the type of company that does a lot of inventory adjustments through inventory receipts. So the key to this is just say no. When it comes to inventory receipts, if it's not attached to a PO, don't do it. I do use inventory receipts for adjustments sometimes, but they always equal zero if I'm moving from one part number to another. So I would do a inventory receipt with, +1 at $100 from one part number, -1 at $100 to another part number, equaling zero. Then it doesn't have that impact. So everyone needs to promise before the end of this call that they will never use an inventory receipt to adjust inventory. Okay, so when we look at purchasing, it starts with a receipt. First step is debit inventory, credit accrued purchase receipts. Then we get the vendor bill where we debit accrued purchase receipts, credit accounts payable. And then the final step is I write my check, which is a debit to accounts payable and a credit to my bank account. Pretty simple, but there are 3 steps that happen inside of QuickBooks sent over from Acctivate. Okay. So next we have a sales invoice. What happens with the sales invoice? Well, I like to call it like a four-sided transaction. The initial transaction is a debit to accounts receivable, credit to sales income, credit to sales tax payable. So that's a P&L account or balance sheet account for accounts receivable, an income account which is on the P&L, and then sales tax payable is a balance sheet account as well, because it's a liability. I'm going to owe that money. When the customer pays me, I am putting money in QuickBooks in undeposited funds. And this is the concept that people seem to struggle with because they're so used to doing everything in one system. Customer payments generally happen inside of QuickBooks. So I receive my payment there, and it's a separate transaction from the actual sale. Same thing with paying vendors. When I do a vendor bill, it goes over and I pay it out of QuickBooks. I don't pay a vendor outside of Acctivate. So the customer payment, it's undeposited funds, and then accounts receivable. So that's when we receive the payment. And then, of course, when we deposit it, everyone should know how to do a deposit inside of QuickBooks. I go to do my deposit. It debits my bank, credits undeposited funds, clears out that account. And money's in the bank, everyone's happy. So the second side of it, so we talked about the sales invoice, the first side of it, which is the revenue. The second side of a sales invoice is cost of goods sold. It's literally a credit to cost of goods sold, a debit to cost of goods sold on my balance sheet, or my P&L. Man, Need more coffee. It is a debit to cost of goods sold on my P&L and a credit to my inventory asset, or reducing the value of my inventory on my balance sheet. This is important. It also sends these over as journals. So you're not going to be like in QuickBooks, you can actually go Control Y on a transaction and it'll show you accounts receivable, the cost of goods sold, everything in one transaction. These are two transactions, one for your sales transaction and one for your cost transactions, are going over separately into Acctivate. Okay, so your sales invoice, again, cost of goods sold, inventory asset. And this is the way it flows. Wonderful T accounts say our invoice is credit to sales income on the P&L, debit to accounts receivable on the balance sheet. Our second transaction is undeposited funds with the payment. This happens inside of QuickBooks usually. Accounts receivable credit, debit to undeposited funds. When I make my deposit, it is a credit to the undeposited funds on the balance sheet and a debit to my bank. Okay, so next we're going to talk about inventory adjustments. Everyone has inventory adjustments. Stuff goes missing, stuff gets broken. So when you create an inventory adjustment inside of Acctivate, it is going to simply, I like to tell people, inventory adjustments, I'm adjusting by a number. So if I have 100 in stock and I count it and I should have 98, I am going to adjust it by 2. I'm going to reduce it by 2. So the actual transaction, if I'm reducing it, is a debit to inventory adjustment, a credit to inventory asset. So I'm reducing the value of my inventory and increasing the expense side of my inventory adjustment. And if I have more than I thought, I'm doing the opposite. I'm reducing I'm increasing my inventory and reducing essentially my cost of goods sold line in inventory adjustments. That's an account that I always keep an eye on, because if you have too many adjustments, we need to figure out what's going on. Okay, and this is the way it would look in QuickBooks, debit, inventory, asset. And everything, by the way, in Acctivate is going to come over. Every journal is going to have the word Acctivate. And oftentimes, I'll see adjustments or journals to QuickBooks that I know weren't originated by Acctivate, because the memo doesn't say Acctivate. When we do teaching for accountants, and we're talking about inventory, we'll actually ask folks to stand up and raise their right hand, and we'll say, I will never do a journal entry directly to the inventory asset account. It's a common thing, but we want to make sure that Acctivate's controlling your inventory asset, not a journal entry. So there should never, ever, ever be a journal entry. We've actually asked into it to make it like accounts receivable and accounts payable, where you cannot do a journal entry without allocating or picking a customer or vendor. We've asked for the same thing with inventory, where you can't do a journal entry to inventory directly. Okay, inventory issues. This is a funny one. People tend to think of the word issues as being a problem, and that's not what an inventory issue in Acctivate is at all. This is to take something out of inventory for a non-sales purpose, meaning I'm not selling it to a customer. So I'm going to issue it out. It'll take the item out of inventory, allocates the cost to the GL, and I've seen this where, I have a client that manufactures lighting. They'll redo the showroom. It becomes a fixed asset. So they'll issue it out to fixed assets. Owner takes it home, takes something home. We want to take it out, go to shareholders draw. Marketing asks for items, but I want to take them out of my inventory, but I don't want them hit my sales or COGS, because that's going to throw those numbers out. I want it to go to the correct expense account. So inventory issues are a way of removing items from inventory for another purpose that isn't related to, let's say, that falls into a different GL account than would be traditional. So one of the things that people often ask me is, how do I find out what's going on? You know, I see a transaction in QuickBooks that's got a journal entry number. Um, what does that relate to? So there's the inventory detailed journal report. It's under inventory reports, transactions, detailed journal. If you go into QuickBooks and you're wondering what that transaction was, you just pull that journal entry number and go into Acctivate, and it pulls up all of the things that happened. So this particular transaction here, 1394, that was an inventory receipt, and it hit accrued purchase receipts and inventory asset. So that was the debit and credit account. Journal 1395 hit inventory asset and supplies account. So it's just an easy way of being able to look and say, this transaction, this journal entry in QuickBooks, what actually happened? And you can go back into Acctivate and take a look at it here. Closing dates. It's another important one. People like to put closing dates on, and I'm a fan of that because you don't want people going back and changing journals. So the key to closing dates is you have to have enough time for everything to clear. So one of the things that Acctivate does that I think is absolutely brilliant, and I always talk about this to folks, whoever enters the vendor bill is the most important person when it comes to actual true costs in the system. And I'm going to jump back to the vendor bill. Okay, so at this receipt pulls in whatever dollar figure we put in for a cost on the PO. But Acctivate's so smart, when I enter the vendor bill in Acctivate, it will go back if that number is different. So I said on the PO my cost is $2. Let's say it's $2.25 when I get the vendor bill. I get up, I verify that that's the right cost. When I enter the vendor bill in Acctivate, it's actually going to go back to this original receipt and say, wait a minute, this is supposed to be $2.25. It will update the receipt. So it's going to update this original transaction of inventory asset and accrued purchase receipts. And then any subsequent transactions. So if I've sold this thing since I received it, and then I get the vendor bill, it's going to update the cost of goods sold for the sales. So in conjunction with the concept of closing dates, you want to make sure you have enough time to clear those bills out. Because if I try and go back, if I put a closing date and then I get a vendor bill and it's different, it's going to try and adjust that accrued purchase receipts, that original transaction, the receipt. It's going to try and adjust that, and Acctivate's going to go, no, you can't. So it will allow you to do a prior period adjustment in the current period, but you're not reflecting your true cost going back. So there's a timing piece of it. And usually I'll have a conversation with folks about how long between the end of between your bills when you receive the goods and bills are there, and it shouldn't be that long. If you've got somebody that's taking months to get you a bill, I would be a little concerned, and I would actually, well, I would ask them, but you might not want to because you're floating their money for a bit. And so we'll go back to the closing. Negative inventory, the bane of my existence. There should never be any negative inventory. I oftentimes will turn off, Acctivate the ability to go negative. We were the ones that requested that Intuit not allow negative inventory, and it took us 8 years of asking them till they finally put in a preference in 2016. It is impossible to have negative inventory. It's usually a timing thing, but financially, negative inventory reduces the value of your inventory. So I had a client that was using a service item. They were using subcontractors. So and rightly, the item had been created and it was set to actual cost. but they weren't entering the bills properly in Acctivate. So it went negative. Well, when it goes negative, it could only use the last cost. So the last cost or the last subcontractor bill they had was $98,000. It actually, and they were, I'm trying to remember how many they were out, like there was hundreds that they had never entered the bill properly. So their actual inventory value on the balance sheet was a negative number. You just can't do that. So negative inventory is very, very bad. It should never be allowed. And if it is allowed, you should have a report that says this is the negative inventory. It needs to be cleaned up as quickly as possible, because negative inventory is having can have a pretty significant financial impact. Synchronizing with QuickBooks, people will often ask me about synchronizing with QuickBooks, how often, when. I always say as often as you need. It should only take a few minutes to do a sync. If it's taking hours, then there's something going on. And we've been able to identify that. I had a client once that I went to site, and the first thing I like to do is do a sync before I start work. So I went to do the sync, and she stopped me and said, no, you can't do the sync because it takes 3 hours. I went, well, then something's wrong. And she goes, no, we were just told that over time it just takes longer and longer to sync. And I went, no. Like, how are you going to run your business? You can only sync at night because it takes 3 hours, and then you can only sync on weekends because it's going to start taking longer and longer. Then it's long weekends, and then you have to close for a week. No, actually with the help of Acctivate, we got into the back end tables and found a payment transaction. I called it a phantom payment transaction. Deleted it, got rid of it, and then I told the client, go home. It's still going to take the 3 hours to sync the first time, but then it'll take under 10 minutes. And she goes, I don't believe you. So we started the sync at the end of the day. And she texted me that night and said, because I told her to go in and do a second sync, she texted me and said, yeah, you're right, and it took less than 10 minutes. So if your synchronization with QuickBooks is taking a considerable length of time, something is wrong. If you have to change something, so if I've got a closing date set in QuickBooks and I need to change something to let it go back in time, you have to remove the closing date in QuickBooks, sync, which allows it to open up the transaction, and then it'll send the transactions over, and then you can put the closing date back on and synchronize again. Usually you have to be careful. I like to know what's causing the change, because I don't want to span fiscal years or sometimes fiscal periods. So we want to see what somebody has done that has caused this to actually happen. So the other types of adjustments that we didn't touch on, but we're going to talk about a little bit, are there's another type of inventory adjustment. It's called an inventory balance adjustment. I always like to tell folks that the inventory balance adjustment, and it works like an inventory adjustment, but it only should be used under the supervision of an adult. So what an inventory balance adjustment is I can adjust both the quantity on hand and the value at the same time. So I'm adjusting to a number. So if I have 100 in Acctivate says I have 100 in inventory at $1 each, and I want to, and I actually have 200 at $2 each, I can use an inventory balance adjustment. I would change it from 100 to 200, and I can change the balance to $2. At the back end of that transaction, it's going to debit my inventory for the increase of $300, because originally I had 100 at $1. So now I'm saying I've got 200 that are worth $400. So it's going to debit my inventory and credit inventory adjustment for that $400. But the problem is that I've now locked in that quantity, that quantity of 200 forever and ever on that day. So if I go back in time and I say, oh, I forgot to do a receipt, that's why it was out, and I go back and I do that receipt for the 100, it's actually going to adjust the adjustment. It's going to leave that quantity that I've typed in there, the 200. It's going to leave that there, and it's going to say, no, you told me that you had 200 on this day, so I'm leaving that at 200. I'm just going to use this and adjust the adjustment, that inventory adjustment, the debit inventory for $300, credit inventory, debit inventory for $300, credit inventory adjustment. It's going to adjust that adjustment in the back end. You won't see a physical change inside of Acctivate for the quantity. So that's why I like to say jokingly that it should only be done under the supervision of an adult, because there are very, very specific reasons. And any clients that have worked with me know that when we do inventory balance adjustments, I will repeat that time over and over again, that this is now locked forever and ever on this date, this amount, this quantity on hand, and this inventory value. So it's an extremely important concept. It's actually, there aren't a lot of transactions that go over to QuickBooks. It's a great time to open up for questions, because those are overviews that I gave you, but I'm sure that people have individual or very specific questions around what their own issues. So we're going to look at some of the questions. Okay, so Frank, you said something to the effect of no errors. So I'm assuming that you're talking about the sync. Define a long time. How long is a long time? Because if it's over an hour, then there's something else going on, even though there's no errors. Takes 2 hours twice a day. I would put in a support ticket, because chances are it's getting hung up on payments. Payments seems to be the biggest culprit when it comes to this type of thing. Yes, a copy of the presentation. This will actually be posted as a webinar in the Acctivate Help Index. Henry wants to know, is there a way to track inventory sub-accounts in QuickBooks? And the answer is absolutely. You have to set up a warehouse for each inventory asset that you want to track, and they would have to be a separate warehouse, which involves transferring. And Frank, even with thousands of invoices a day, this is on the sync, it still shouldn't take 2 hours to sync. Let's see what else we have. Okay, let's see what else we have coming up. Please show me the step-by-step to see inventory receipts to adjust overstated accrued purchase receipts. So that's a journal entry, and I'm going to pull up Acctivate, and I have to share it. So give me 1 second. So I'm going to pull in. I use 3 reports. Let me share. New share. There we go. Okay, you should be able to see Acctivate. I'm just going to pull in the reports that I use. So there's 3 aspects to how things happen for accrued purchase receipts. Now, one of the things about this is that I can't go back in time on accrued purchase receipts. I can only look at in the moment. So there's three aspects to accrued purchase receipts. This is where I've received the products, but I don't have an invoice. Okay, so in this file, and you guys you guys can see this, correct? I'm assuming that we can. So this tells me that here's the PO number. I've received 1,200. I've got 0 invoice. I received them at this, so it's $1,140, and it just goes through each of them. So I've got a $1,891.50 value that should be sitting in accrued purchase receipts. Then the second side of this is sometimes I get the vendor bill and it gets entered before I get the goods. That's a different conversation. I'm not a fan of that. I'd rather hold on to the bill or handle that differently, but it would be $1,891 minus whatever's on this report. That should be the balance of my accrued purchase receipts account, those two numbers. But if somebody's been using accrued purchase receipts to do other entries, and you can see here, there's some pretty significant numbers here. Somebody has to explain to me what these transactions are, where these were received without doing an inventory adjustment, like why these are here, because these would be sitting in my accrued purchase receipts accounts right now. Now, no one panic that the $500,000 that's sitting there, because this is my demo file, so this is not somebody's real company. Okay, so let's see what else. So that, Anna, that is the report that gives you the value of the accrued purchase receipts. Joe, okay, Joanne Edmonds, sorry. On the P&L under COGS, there's only one huge purchases others account. Is there a way to break it down on the P&L to show individual items so the shareholders can see what was purchased? Now that's going to go to your configuration management. So again, if that's your COGS account, I'm assuming, and so that's going to be how you've got your customer, your setup here, which is usually product class, and that would become a matter of changing your COGS account on this side. Now, the reason it's going to other is that you've got sub-accounts under your COGS account, but here in your settings, you just have cost of goods sold. So that would explain why that's happening. I'm just picking some of these. The reports that I just showed are ones that I've built. They're not standard. You can find a consultant, or I can talk to Acctivate about making them available. Brian, we have a ton of APR without POs. How do you clear that? It's literally, you want to reconcile two accounts. I always want to do accrued purchase receipts and inventory asset. So each month, there's two things that you should be doing. You should be running your inventory valuation report. Well, Acctivate thinks, and you should be balancing to make sure that the inventory asset account matches the Acctivate valuation. It's a common thing that people don't do, even in QuickBooks. So I would open up my QuickBooks file. Of course, it's being a little bit slow. Of course, because we're doing a live presentation, it decides to be a little bit slow. Okay, so at the end of my inventory valuation, I've got 530,000, and I would go into QuickBooks and look at my inventory asset to make sure that those match. And then I would do the same thing with accrued purchase receipts. And then at the end of the month, if it's not significant, and that's part of a conversation with your consultant or with your accountant, what is material? I'm not going to spend 2 hours hunting down, $1,000. But I always try and define what's a material number when we actually worry about it to a larger degree. And once we know what that number is, if the difference is $10,000 and we've decided that's material, we'll start looking into what's going on and why it's like that. What happens if a PO is closed short? There will not be a reconciling issue. So if a PO is closed short, so Mike Rubel says, what happens if a PO is closed short at the time of receiving? What happens or deleted months after the original receipt? You shouldn't be deleting POs. So there are two things that happen, and this is more in Acctivate than anything else. But I see this with industries where you don't back order. So on this particular PO, I've received 250, 750 are outstanding. And if the vendor is not going to supply that, I'm probably going to want to go in here if it's short and change my PO amount to 250. The reason I want to do that is when I run purchasing reports or forecasting, if I look at this product, if I'm never going to receive that, I actually think that I've got 750 on PO. And over a number of POs, that can add up. So short is always, it's always good to reduce it. I just like to keep it clean because a lot of times I'll build specific reports. I can do this, I can complete it. It's going to come off of here. But the reason that's a problem is that if you've got custom reports built, usually we're looking at this number minus this number. So that's why it's important. Let's see. Okay, what are the implications when invoicing into negative for where stock is invoiced in advance but has not been received yet? So you receive stock under generally accepted accounting principles. There's two things. There is deposits on inventory where you've had to say to your manufacturer, here's half the money. Under generally accepted accounting principles, that actually lives on the balance sheet. It's a credit to bank because the money's left my bank account, and a debit to deposit on inventory because it's an asset that you haven't received. It's not part of your inventory. So at that point, it's not touching my inventory here. It's not driving it negative. So because I'm not receiving it, I haven't received anything yet. Same thing if you want to invoice a customer. If a customer pays a deposit, they haven't received the goods. So that is actually a debit to your bank because they've given you a deposit, and a credit to your your debit to bank, credit to a liability account, also similar to deposits on inventory that you owe somebody something. Liabilities are all that you owe somebody something, but if you have not physically touched or moved the products, it should at that point not be going through Acctivate as a transaction. So, and then we always define, there's a couple of ways of doing that. But it's similar because if I don't have the goods, I'm not bringing it in. I'm doing a deposit to inventory or accounts receivable, negative accounts receivable or accounts payable. Okay. Yeah, so we'll take a look at that. There's some open questions here. Okay, that was answered live. Okay, so Peter, this would, the supplier cost of sales on the invoice. So if you don't have the goods, yeah, Lauren just asked. So Peter just is saying that he was thinking in terms of cost of goods on the on the invoice. But and Lauren asked is if you're doing drop ships. So I'm going to touch on drop ships for those of you that are using them. Drop ships and often confuse people, but we'll create a sales order here. I'll throw an item in here and we'll make it drop ship for 100. Now, a couple things that have happened here. First off, oops. So first thing that's happened is that my warehouse option has gone away. So I'm never ever going to receive this goods. I'm not going to see this. So I'm going to create a dropship PO as soon as I approve the credit. Create PO. Okay, so I've created a dropship PO, but you'll notice that the receive button is grayed out. I'm never going to receive this. I'm strictly going to go straight to a vendor bill on this because I'm not receiving it. There's no physical action for me to receive this thing. Okay, create invoice. Oh. Apparently, it wants me to approve the amount. So that when I invoice this customer, it's at $1.85. Because those two are linked, I can now invoice, and it automatically scheduled it because I entered the vendor bill, and it pulled the correct cost over. There's my cost at $1.85 a unit. So that's what's being sent over. Tracy asked the question, is there a better or best way to accept a deposit from the customer? There is an actual help article on this, but in reality, it comes down to this question. At the end of the day, in QuickBooks, what I want to see is I want to see that deposit from the customer as money in the bank, and I want to see that I owe them. So if it's going to be 3-6 months, that's a material length of time spanning potentially fiscal periods. So we want to see that on the balance sheet as a liability, customer deposits, because I owe them goods later. If it's a shorter time, I will do accounts receivable. So I'll debit the bank, credit accounts receivable, so that client will actually have a negative accounts receivable if it's a shorter time frame. And then the third way is always do the debit bank, credit accounts receivable for that deposit. But at the end of the year, look at how many deposits you have and do one journal entry to move it out of accounts receivable into the deposits on account, our customer deposits, so that financially it's set up properly, so your accounts receivable doesn't look weird. I think is the best way to go with that. Let's see, what else do we have? That's done. Somebody asked if I had a Canadian subsidiary or recommended service provider. I'm actually Canadian. I moved from Canada several years ago and don't mind crossing the border. So if people need help, they can always reach out. We can see what's going on and help out. Okay, on the dropship example, how do you confirm that the quantity that was shipped or that the actual was different than what was where did that question go? A question just disappeared. Oh yeah, how do you confirm the quantity? Yeah, so confirming the quantity, the vendor should be sending you a bill of what they shipped, and that's when you're entering that side of it, of the transaction, is when you're holding the bill. If the client tells you they got less, then you need to reconcile that with the vendor. but you're going to send the client their invoice for, however many, 10 or 100 or whatever the quantity is. You're going to get a vendor bill. Your system's going to match. But if the client says, hey, I only got 5, you have to deal with that as well. Okay. And it looks like we have a couple more. Yeah, the reports for accrued purchase receipts, you can send me an email, and we can look at them. It's the reports that I've built.
All right, Keith, I'd say we're just about done. Do you want to pull up your contact information one more time so that way everybody that's still on here will be able to reach out to you
yes.
after this?
Yeah, I will absolutely do that. It should be that one. Let me get this out of the way. There.
All right, so thank you everybody for attending. Any additional questions we'll try and get to before we close this out. But you can also email either Keith at mendelsonconsulting.com, or you can email our support team at support@acctivate.com. Any additional questions. We will also be posting the recording of this webinar to our help site, and that's going to be at the webinars page of help.acctivate.com. Thank you so much.
Awesome. Okay, thanks everyone. Everyone have a wonderful day and have a great 4th coming up.